Welcome. We are still on consolidation. Consolidation, we have specialized transactions. This is the transaction between parent and subsidiary that must be eliminated in full. That must be adjusted before consolidating the statements. One of the specialized transactions is intergroup balances. In intergroup balances, it refers to intercompany indebtedness. It's a case where the group companies owe each other. Intergroup balances are eliminated in full on consolidation from both accounts receivables and accounts payables. Any cash in transit needs to be adjusted before eliminating the group balances. Hence, debit, payables, credit, receivables. And if there is cash in transit, you will create it as an item at statement of financial position. Number 2 is intergroup sale. Intergroup sale and unrealized profit on inventory, or you say closing stock. Intergroup sale occurs where group companies sells goods to each other at a profit. Intergroup sales are eliminated in full from both sale and cost of sales. Debit sales, credit cost of sales. For unrealized profit, this occurs where the intergroup sale of inventory remains in the stock at the end of the year. The unrealized profit is eliminated in full. This is by you debit cost of sale, then you credit closing stock. That is it. When determining unrealized profit, it's important to understand the difference between margin and markup. Margin is in relation to sale. Markup is in relation to cost. Number 3, specialized transaction. Number 3 is intergroup sale of fixed asset. Intergroup sale of fixed asset. Here we have 2 things that we must adjust. This is the sale of a fixed asset by one group of company to another. In case of this transaction, there are 2 adjustments that need to be considered. Eliminating any profits realized. Eliminate any profit realized. Eliminate any profit realized. This is by you debit cost of sale, credit PPE account. Then eliminating, or you say adjusting for overcharged depreciation. Adjusting for overcharged depreciation, you debit PPE account, you credit cost of sale. Cost of sale. Exactly. Then number 4 is the dividend paid. For dividends are the distribution of profit to the shareholders. Dividends may be paid out of pre-acquisition profit, that is pre-acquisition dividend, or paid out of post-acquisition profit, that is post-acquisition dividend. The parent share of pre-acquisition dividend is credited to the cost of investment. That is, you debit bank, you credit cost of investment. Exactly. Parent share post acquisition. So this is for pre. The post or post acquisition, you debit cash book, then credit investment income. Investment income. Post acquisition is like it's a return on investment. That's why we credit investment. You need to note this. Dividend receivable or received from subsidiary are intra-group balances and should be eliminated in full. This one, eliminate in full, eliminate in full, eliminate in full, in full. Also, the dividend you have to eliminate in full. Then we have fair value. This is fair value adjustment. During acquisition, then assets of subsidiary are revalued. You need to adjust those fair value and consolidate that statements. If there is increase or depreciate, you have to adjust all of them. Then we have piecemeal or step acquisition of subsidiary. This is whereby the step acquisition occurs when the parent acquires control over the subsidiary in stages. This is achieved by buying blocks of shares at different times. IFRS 3 requires that the acquisition method to be applied only when control is achieved, that is 50. Any pre-existing equity interest is accounted for in accordance with relevant IFRS. On the date when the entity now acquires a controlling interest, number 1, you remeasure the previously held equity interest at fair value. Number 2, you recognize any gain or loss in P&L for the year. Then number 3, you calculate the goodwill and the NCI in accordance with IFRS 3. The cost of acquiring control will be the fair value of the previously held equity interest plus the cost of the most recent purchase of shares at acquisition date. That's all for specialized transaction. We have 6 of them, and in all this, make sure that they are at your fingertips. Intergroup balances, eliminate in full. Intergroup sale and unrealized profits on closing stock, eliminate in full. Intergroup sale of fixed assets, you have to eliminate any profit realized and adjust for overcharge depreciation. Dividend paid, categorize it if it is pre or post, and then eliminate in full. Fair value adjustment, piecemeal or step acquisition. Those are enough, but allow me to read a question, then we'll do. This question is on piecemeal step acquisition. Illustration: H Limited owns 10% in S Limited at shillings 24,000 in accordance with IFRS 9. H Limited, this one owns 10% in S Limited at shillings 24,000. At 24,000 in accordance with IFRS 9. On 1st June 2018, it acquired a further 50% of S, another 50% of S Limited. We say piecemeal is acquiring control in stages. Equity shares at cost of shillings 160. So at shilling 160,000. Alright, that's on June 2018. On this date, the fair value were as follows. Fair values on this date were as follows. S Limited net assets 200, and then NCI at their value. NCI is 100,000. 10% investment is valued at shillings 26,000. A question now. We are told that NCI is measured using fair value method. Then required, calculate goodwill using both methods. Calculate goodwill using both methods. How many methods do we know for calculating goodwill? Number 1 is full method. Full goodwill method. In this, we'll calculate goodwill as all of it. Therefore, we'll say that the purchase consideration is 26 plus 160, which is 186. 186. Then NCI is 100. So you have 286 286, 286, and then less now net assets acquired, which is 200. Our goodwill will be 86,000. That is for full goodwill method. Let's come to partial goodwill method. In partial goodwill method, we'll calculate the goodwill for parent and NCI differently. Therefore, let's get now the purchase consideration for parent is 186. Purchase consideration is 186,000. Net assets is 60 times 200, which is 120. This one will get 66,000 as the goodwill. For NCI, you say it's 100. NCI is 100,000. Then you less net assets for this, which is 200, which is 40 times 200, which is 80. So the goodwill will be 20. That's all. And we are done with piecemeal step. If you can recognize this, then you are good to go. Then addition of 50 and 10, which is adding to 60% control. Then you are good to go. That's all for our topic.